Hey folks, Dan Frio here, the rate update. Well, the Fed did it. They announced what they're going to do in regards to tapering. So don't go away. We're going to talk about that next. Okay, hot off the presses. It was announced just now from CNBC what the Fed announced they're going to do. Take it away, Steve Leisman.
The Federal Reserve leaving rates unchanged, but announcing that it will begin tapering or reducing its asset purchases of $120 billion this month. It will do so by $15 billion, $10 billion of treasuries, $5 billion of mortgage-backed securities. So the taper begins this month, $10 billion of treasuries. The Fed will taper again in December. It's already announcing the decision for next month and expects to do so in following months. However, the Fed says it will adjust the taper amount if warranted by changes in the economic outlook. On the economy, it says it continues to strengthen, helped by vaccines and vaccination, but the COVID resurgence from the summer, the Fed says, has slowed the recovery. There, the Fed taking note of lower jobs reports as well as lower GDP. Inflation, the Fed says, is elevated. A little bit of a change in the language here, reflecting, quote, factors that are expected to be transitory, rather than just saying reflecting factors that are transitory. They're expected to be transitory. The Fed saying supply demand imbalances have contributed to price increases. It expects the easing of supply constraints in coming months to reduce inflation. It also expects to maintain ultimately an accommodative stance on monetary policy. And responding to what Liz was looking for, I've now read the statement a couple times as quickly as I could. I don't see any comment at all on rate hikes or rates at all, except to say the Fed expects to maintain an accommodative monetary policy or stance until its goals are achieved. Finally, the decision was unanimous. Kelly?
All right, so based on this, what's going to happen? All right, so let's get to it. Headlines read, Fed to start tapering bond purchases later this month as it begins pulling back on pandemic aid. All right, so that's what Steve Leisman just spoke about. Let's go down through and look at some of the nitty gritty that they stated. And I'm going to point out a few things, and it's probably going to get pointed out, but it should get pointed out. Let's go with that one. So the first thing is tapering of bonds will start later this month. I didn't anticipate that one, guys. My apologies there. I thought it was going to wait till December, most likely January, but they feel that they're way behind the eight ball right now, so they want to make adjustments as soon as they can. So I can't really blame them on that one. All right, the process will see a reduction of 10 or 15 billion each month, 10 billion in treasuries, and 5 billion in mortgage-backed securities, okay, from the current 120 billion levels. All right, I'm going to read all this, and then I'm going to show you how this is going to affect rates just because of this. No other factors involved, all right? The statement approved unanimously stressed that the Fed is not on the preset course and will make adjustments to the process if necessary. This is one that I found kind of odd, and they're leaving the door open for them to maybe halt this at any time they feel. And here's why. The committee judges that similar reductions in the pace of net asset purchases will likely be appropriate each month, but is prepared to adjust the pace of purchases if warrantable by changing the economic outlook, the committee stated. Okay, that's kind of good news, I'll say, is right now they stated that they're going to do $15 billion in tapering in November and December. And then from there, they're going to monitor the situation, meaning employment and inflation, and see where they goes from there. But let me just kind of show you how this works. All right, remember how every day we talk about, what's the supply, demand, and how much prices vary and so forth. So this is probably the best way that I can explain this. Let's say in this graph right here, the 3,000, this is how many mortgage-backed securities are offered. Okay, I'll just keep it a stagnant number. So let's say there's 3,000 mortgages in this mortgage-backed security. All right, the Fed is right here right now. Okay, so they're buying up at the price of X, and we'll keep it here. This will tie together, so bear with me here, folks. All right. So that basically puts our equilibrium right here. Let's say $40. Let me move that up. At $40, that's where we're at an equilibrium based on this amount of demand. All right. So now let's change the demand. All right. We're not changing the supply at all. We're going to change the demand. So the demand now, because the Fed, just the Fed alone, is cutting $5 billion in their purchases, that means the demand is shrinking. Now, what price are we at to hit equilibrium? Well, we're now at, say, 25. All right. So we're now at 25 because of the less demand than where we were at 40 when the demand was higher. All right. So let's figure that out. As the prices go down, what happens to yields? Well, they go up, as we explain every day in this chart right here. This is what's happening to the MBS market, okay? This is what's happened to the last quarter. What we want to focus in, or my thoughts here, where I want to explain, is how the price affects the yield or your mortgage rate, okay? There's an inverse relationship, as we stated here. The less demand, the lower the prices, okay? So if the prices go down, like we've seen here, mortgage rates go up. So just by the Federal Reserve coming in saying they're buying $5 billion left, or $5 billion less, that's automatically going to pull back the demand, which is then going to bring down the price and raise up rates. Now, where's the equilibrium? Well, that's what's tough or hard to figure out. So if we go back, what we do is we go back and say, well, where were we pre-pandemic? And that's where my earlier video came from. Down through here was prior to the pandemic. Where were we? We were at 98. All right. So I don't think it's obscure to say that potentially bond prices could come all the way back to here, because that's where we were pre-pandemic. All right, so I just want to explain what's happening just by the tapering, what is going to happen with mortgage rates. So the economic calendar for today is we saw payroll numbers doing very well, more than expected. Previous number was 568,000 people. Consensus was 400,000 new jobs. We got 571. So that's great news there. All right, interest rate decision and Federal Chairman Powell, they spoke today. Now what's going to happen in the next 2 days? We're going to pay real close attention to the initial jobless claims and continued jobless claims. And then we're also going to monitor employment, the hours worked and the payrolls and everything. All this is going to give us a little bit better shot of what's going on in the future in regards to jobs and inflation. All right. Also, in the next couple of days, the Federal Reserve is going to come out with everything in writing that they've put here, and it'll get dissected to see if there's anything in there that just may throw things for a loop, or that just has changed since they spoke last time. Where are we intraday? It's a roller coaster. Look at this. We opened up, plummeted all the way through 2 o'clock when they announced, or the Federal Chairman Powell came out and started talking, and we've rallied since then right into these levels here. So we're down 14, but we've been down much further. We were down about 20 or 20 some or so earlier, and they're just bouncing around. So people are digesting this information, trying to figure out what it's going to mean in real numbers when it comes to bonds and stocks. So that's the report right now. That's all I got for you guys today. So if you're looking for a mortgage, or you need some assistance, you're in a forbearance, you want to refinance, you want to buy a house, how do you find us and how do you reach out to us for some help? Well, just go to therateupdate.com. And this is the best way to get a hold of me. Give us a call at 844-775-LOAN. Apply online. We have this feature that pops up right now. It gives us what would be your perfect rate? What would be the rate that you need to hear or get to possibly refinance? You're going to put that number in here. What's your name, your preferred rate? You click that, it'll take you to a screen and you tell us what rate you're looking for. When that rate becomes available, we will let you know. But if you want to reach out to me and my team, give us a call at 844-775-LOAN. Schedule a meeting. This is a calendar link that you can click here. Schedule a meeting with me or one of my teammates. Do it that way. Or if you're in the process right now of a mortgage and you got a loan estimate and you want me to review it and get back with you to see if we could possibly get you a lower rate or lower fees, just go to this section here under resources, upload loan estimate, click there. This is an online site that's 100% secure. You're going to click here to say you're not a robot. Then you're going to tell me a little bit about yourself, how I can get back to you, and you're going to download your loan estimate in there. And give me an hour to review that and get back with you. If it's over the evenings or on weekends, please give me a little more time to get back with you. I promise you, though, I or one of my teammates will get back with you. So if you find value in my channel, don't forget to give me a thumbs up, subscribe down below, hit the bell every time I post a video. You get an alert. I will see you guys tomorrow. Bye-bye.